A very good afternoon and a happy new year to everyone. We released the first edition of the year yesterday on the 5th of the month, and like we do every year, we wanted to start things off a little differently. As we were writing it towards the year end, we didn't want it to be an outlook for the year ahead, and honestly, we didn't have one anyway. Instead, we took a different approach, almost the opposite. We tried to burst some widely and rather stubbornly held market myths. Last year, we started the year with 7 market myths. This edition builds on that quite meaningfully. We have 12 this time. Some of these may surprise you, some may make you a little uncomfortable, and some may still refuse to go away. But we'll keep coming back to the data for you. I will now invite Sahil to start with the presentation. But before that, just as a side note, during the course of the presentation, you all can put in your questions. We will collectively take them towards the end. Over to you, Sahil.
Thank you, Pragati, and Happy New Year to all of you. Um, so this is, as Pragati said, first edition for 2026. And our idea was to think, what are some of the most important ideas that go around in the market, and some of them are myths. There are many ideas which are correct. There are some ideas which sound correct but may not be so obvious. And we thought that we'll put some data around that and see if we can dispel some myths around it. So I will share my screen and we'll start with our presentation. As I said, we wrote DSP NETRA and we release it 5th of every month. So on 5th January, this edition was released. One of the things that we were discussing internally today is on data, right? And one thing is that very, very rarely discussed property of data is that it is toxic in large quantities and even in moderate quantities. And specifically, if you try to use data to make economic projections, this is a property of data. And the reason is that if you have huge amount of data, you can twist it anyways and create any projection. Our idea is that we want to use data for negation, not for projection. So when we present data, what we are telling you, what does history show? And are there any ideas that we can negate, which we can say that, if we don't do this, then probably we'll be better off, right? Rather than saying that this is my forecast or this is my prediction, which of course nobody knows how the future is going to pan out. So we'll try and look at the data from that lens in this edition. So as I said, we'll present some, stubborn market myths. Why are they stubborn? Because most of these market myths, sound so convincing that we start to believe that they're actually true. So let's look at the first myth. First myth is that yielding assets like stocks are always better than pet rocks like gold. So there was a time when gold was completely thrown out of the asset allocation window, and a lot of asset allocators thought that gold is no longer an asset which appreciates in value because for many years it had not done so. After 2011, for almost 10 to 12 years, gold did not gain in price, and therefore it sort of sat in the background. We presented this data about 1.5 years ago, which shows you that gold in the 21st century has beaten all equity markets. So if you look at the data on your screen, you will see that how gold in developed markets has beaten all developed markets, and in emerging market it has beaten all emerging markets in local currency. Why do we compare gold returns in local currency? But what we are saying is that if you are a investor sitting in, let's say, Turkey, Argentina, Brazil, India, Mexico, and if you buy gold or if you buy stocks, what will do better in the 21st century? As we speak today, because of the stellar rally that we've seen in gold, gold is now doing better than most of these assets. So, of course, there is a start and endpoint bias because it's only a 25, 26-year data. It has a starting point bias and an endpoint bias. But one very important point is that there is also data bias in our investing careers, in our investing horizon. Think about it that if an investor was born in 1980 Japan and started to invest in, let's say, when that investor was, let's say, 15 or 20 years old, it would have taken him very, very long time to create any meaningful returns from the stock market, right? Because of no mistake of that investor, just that the investor was born in that era, right? So we can't choose our eras. It is called an ovarian lottery. Similarly, people who had portfolios in the last 25 years or 26 years and they ignored gold, thinking that stocks are the only investments, the results are in front of you. The only problem is that these are also cyclical, okay, which we will come into the second slide. But one very important point in this slide, if you look at the bottom left table, it shows you that in many countries, uh, it is not very easy to, outsmart gold. Let me magnify it a little. So if you look at this table, if you see that there are very few stocks even among the large stocks in most countries that beat gold. So, for example, in the Nifty 500 universe, there are 24% or 1 in 4 stocks have beaten gold in the 21st century. And in US, that number is 5%, only 25 stocks. In fact, out of these 25 stocks, more than half of these stocks are technology stocks. Just imagine that. In UK, only one stock has beaten gold. So it's not very easy. If you're a stock picker, which means that if you are a non-diversified investor, non-mutual fund investor, non-index investor, it is even more harder for you to beat gold, or it would have been even more harder in the 21st century to beat gold. This does not mean that gold is the only game in town, which is our slide number 2. Most people will now make the mistake thinking that since gold has beaten everything, this probably will repeat because of all the stories that we hear that the world is moving towards gold. Central banks are buying gold. Of course, all those are true, but the problem is that most of it is in the price. For example, now you see the chart on the screen. It shows you 5-year rolling returns of gold versus stocks. And the stocks are in local currency. So, for example, in India, we have taken Sensex going back from 1982 and took 5-year rolling returns. You can see there are very number of periods where gold has beaten stocks on a 5-year rolling basis, just like it is doing right now. But these periods are not too many. For example, in India, gold has outperformed Sensex only 23% of time, not a very high number. In US, the number is slightly higher at 36% of time. Majority of that happened in 2003 to 11 cycle when gold was in a massive bull run and US started with a dot-com bubble, right? And that was the era when gold outperformed US stocks by a very, very wide margin. Today, we are back to that era where gold has started to outperform, but US stocks are not in a bear market. So imagine the outperformance of gold. It is outperforming stocks on a 5-year rolling basis in a bull market in stocks, which is unbelievable, right? In Europe, the story is the same. Stocks are now getting beaten by gold. It has happened in the past. In Europe, 50% of the time stocks, gold has outperformed stocks, right? A high number. And in China, it's 38% of the time. I want you to look at all these 4 charts very carefully and notice a very important trend. In the last 5 years, there is a trend where gold is rising with stocks, right? In the past, you would have seen that on many occasions, this correlation was opposite, where gold was rising and stocks were falling, or vice versa. There are also other periods where both were falling, right? One very important metric to look at is that gold is loosely uncorrelated or loosely correlated with stocks, which means it has its own cycles, right? This is a unique cycle where it is rising with stocks. It has happened in the past, but it's a rare occasion when it happens. Now, 2 very important takeaways. One, when a non-yielding asset, gold doesn't have any earnings or dividend, right? When it starts to build yielding assets. So now when we looked at myth number 1, what was the myth? That yielding assets like stocks are always better. What is the basis of this myth? The basis of this myth is that stocks have earnings and dividend, while gold has nothing. So if there is growth, if the business is growing, then of course my equity value will go up. So it's a very, very important logic, which is true, that logically stocks should do well because they have earnings. Gold doesn't have any earnings. So it's a very, very logical point. But we've seen that opposite has been true. but it is not based on logic. It is based on cycles. And there we broke this myth that because it is cyclical, there will be occasions when gold will beat everything, which it did, which it is doing right now. Myth number two tells you that this is also cyclical, which means that when gold starts to beat yielding assets, you should become more circumspect about putting more money in gold, right? Which is where we stand today, right? Which means that gold's outperformance is also cyclical. It is not secular. There will be period when it will not perform and stocks will perform. And another uh, wrong lesson that we should not take away from this slide. Some people, I think some of the readers, when I spoke to them, asked me a question that if gold is now beating stocks and we should not be thinking of allocating more to gold, therefore should we be buying more stocks? Okay, so now the corollary is not true. Okay, which means that if gold is beating stocks, you are not buying gold. Does that mean that that exposure should go to stocks? This analysis does not tell you that. Okay, it's slightly confusing, but it is true. It is akin to looking at ratio charts of equity to gold and saying that because ratio has touched a particular level, we should be buying stocks. I think that is a misinterpretation of data. The reason is that if gold begins to beat stocks, that does not mean that stocks have become cheap, right? For example, in case of United States, at this point in time, it sits at the most expensive valuation ever recorded in history, right? So, which does not make them particularly cheap, right? So maybe the allocation will go somewhere else, maybe to the debt market or some real estate or someplace else, or maybe to cash, right? But the wrong lesson to take is that because gold is now beating stocks, therefore we should be circumspect and very careful about additional investment. Therefore, let's go to stock. That's not the conclusion that you should take away. Myth number three, which very closely correlates. So first we said that stocks are not the only game in town. You should also look at gold. In the second myth, we told you that gold is not the only thing. It is cyclical in nature. So eventually, what is right? The right frame of reference is that reality is very, very mixed. That is what we've written. That when you asset allocate, when you mix up asset classes, probably the outcomes are much better. So here we present a table which shows you the returns for different countries when you invest in equity, debt, international equity, and gold. And you see the multi-asset returns are more or less superior to most asset classes. So for example, in India, the only asset class which is beating multi-asset is gold itself, right? In US, equities are still beating gold, right? Gold is still beating multi-asset. So this is something which you need to be very careful of. What is most important point? That after you mix assets, you get two benefits. One, you get a better experience in terms of returns because some asset will do well, some other will not do well. So your overall experience will be more smoother. Second, your volatility of the portfolio will reduce, right? Most likely, if one asset class is not doing well, something else will be stagnant or doing well. It will reduce your overall portfolio volatility. Now, why is it important? The only reason for us to look at this data and understand that multi-asset is a good strategy is to think in this way that if there is a very large market move, probably this strategy will move lesser. It will be less volatile. And therefore, if it is less volatile, the chances of me making a mistake by taking wrong decision will be lesser. So for example, let's say our portfolio value is at 100 rupees. Some unforeseen, uncertain event happens and equity markets fall 30-35%. Maybe a multi-asset portfolio falls lesser, maybe 15-20, whatever is the number. So the possibility that I will panic is much larger in a pure equity portfolio or maybe a pure gold portfolio or in a pure debt portfolio versus a multi-asset portfolio. And therefore, if I don't make a mistake and I stay invested for a long period of time, then my compounding will be much better, right? And that is the use case of a multi-asset allocation strategy or mixing of assets. And therefore, all the three slides tell you that reality is mixed. When you mix assets, your outcomes improve, and therefore do not think that there is only one asset based on recent or past performance which I should be overweight or I should be only owning. That is not true. You need to mix up all these assets. All of them have their own place in the portfolio. The next section is a two-slide section which talks about economic growth and its linkage to the stock market. This slide shows you various countries. Then it tells you what are their real GDP growth rates. For example, in case of India, last 30-year real GDP growth rate is 6.1%. Real equity return is 4.7%, slightly lower. What is real equity return? Which is return minus inflation. What is real GDP growth rate? Nominal GDP growth rate minus inflation. Now, what is interesting is that we divided this table into two different parts. Slower growing countries, which means just sorted the countries from fastest to slowest. And something interesting came about. Countries where GDP growth was slow, their equity returns were actually better than countries where GDP growth was fast, which is very counterintuitive, right? Also, in these countries where growth was slower, their equity market returns were actually better than their GDP growth rate. Now, this is also very, very surprising. Now, first, wrong lesson to take. What is the wrong lesson? That if economy grows slow, equity returns are higher. This is not the lesson that we should take from this slide. What is the lesson? That equity returns are not dependent only on growth, which means that if GDP goes from X number to Y, from let's say 4 trillion to 10 or 20 or 30 or 40, it does not guarantee commensurate equity returns. In fact, if you see, for example, in case of China, which is the highest growth rate country, equity returns are much lower than other countries. Skip the case for India, which we all of us know. Look at South Korea. Real GDP growth rate of 5.4, equity returns of only 1.4, right? Much lower than what people would have expected over a period of time. And mind you, these returns that India has shown, 4.7 is a very, very credible return, very good return, right? In case of some other countries, for example, US, the returns are 5.9%, right? Which are stellar numbers, right? Over last 30 years, adjusted for inflation, a 6% return is a very high return, right? And therefore, do not make the mistake for, looking at growth as the only parameter. Also, we have written that what drives return, right? In the last January edition, we wrote that one of the factors that drives return is shareholder return. If companies are able to deliver returns to shareholder, then equity markets also perform. If they are not, then growth, although will create prosperity in the economy, it may not create prosperity for the shareholders. It's a very important consideration. Of course, there are more other levers, and we will write about those levers in our future publications. The next myth is that if GDP goes from X number to Y number, it is going to be, let's say, a linear progression or a very strong growth rate. So, for example, we presented a data from FY71 to FY25. How often has Indian GDP grown at 8% YOY growth? This is real GDP, domestic India growth. You can see there are only 7 occasions until pre-COVID where India has grown at 8% plus in the real GDP growth rate. When you smoothen this number, when you make it, let's say, 5-year CAGR, only I think in FY08 cycle where Indian GDP grew at about 8% CAGR for 5 years, right? 5-year CAGR of 8%. Other than that, we have not hit this number. So which means that this 8% growth rate number is not easy. It's a difficult number. Now, second is that we use some of these projections to project our GDP numbers. For example, at this point in time, India's GDP is around 3.5 trillion or 3.8 trillion. If you look at the December number, for GDP is not out, but let's assume that we take December 2025 trailing 4-quarter number, GDP will be around $3.8 trillion. Now, if you compound it by, let's say, 8% or 9%, if you compound it at 8.9%, in the next 25 years, the number reaches 30 trillion, right? Now, this number is the dollar GDP growth rate. When you look at the past history, look at the last 25 years, or let's say look at the last 50 years. In the last 50 years, India's nominal growth rate has been close to about 5.5 to 5.7% CAGR. Okay, real GDP growth rate for India. Nominal growth rate has been around 12.25% in the same period in the last 50 years. Data is available. The dollar GDP growth rate in that period is around 7.5% or so over the last 50 years. Now, if you want to compound at 8.9 or close to 9%, you have to outgrow your own history in dollar terms by around 140 basis points, which is a very, very difficult task. Second assumption, when you look at this data, how does this data correlate to, let's say, a dollar GDP growth rate? Because I think there was some confusion regarding that number. When you look at the dollar GDP growth rate, that number flows from India's nominal GDP adjusted for currency depreciation. So, for example, if our currency depreciates by, let's say, 2% CAGR or 3% CAGR or 5% CAGR, depending on which number you take, it eats away from our dollar GDP over a period of time, right? For example, case in point, if you remember just about 2 quarters ago, there was some discussions that by the end of the year, Indian GDP will cross $4 trillion. And that assumption was basis that rupee will hover around 85, 86. But suddenly rupee weakened to 90. Although the Indian rupee GDP went up, but our dollar GDP actually remained stagnant because currency depreciated. And therefore, let's say over the next 10, 20, 30 years, if rupee continues to depreciate that the way it has, then probably achieving 8.9 or 8.5% GDP growth rate may not be enough. It is going to be a hard task to hit these numbers. And we've actually written here that let's say that if we follow our past growth rate, assume that we are able to do 7.2% dollar GDP growth rate, right? If we do that, let's say, then we double our GDP every 10 years, right? So in that scenario, probably we'll reach $20 trillion. As I said in the beginning, we do not have any forecast. What we are saying is, what is the base rate of India's, let's say, dollar GDP or real GDP growth rate? None of them is close to 9%, which is what this projection is. Second is there a history of rupee appreciation? There is a history between 2003 to 7, rupee appreciated somewhat, but that appreciation is not enough for this number to hit $30 trillion. It's going to be a very, very tall ask. And we'll maybe in the future segments present some ideas on how to think about currency appreciation or depreciation. For example, if you look at globally, how many currencies have appreciated against the dollar over a 25, 30-year period? You will find very few. And by what magnitude? Maybe Chinese yuan went from 8.3 to 7 now, which is the fastest growing economy in the world by a margin in last 1,000 years. And there are other countries like Swiss franc for other reasons, which has appreciated appreciably against the dollar. But very few countries which run a deficit on the balance of payments, specifically on the trade account, has seen currency appreciation. In fact, most exporters in Asia also saw currency depreciation rather than appreciation. And therefore, we have to be very careful in any sort of projection. Most important point, as investors, we should be conservative in our estimates so that the outcomes that we base our estimates on do not fool us. So if our inputs are conservative, then probably we'll take more nuanced approach and lesser risks in life. The next slide is that if there is so much money, stocks will keep rising, right? And this is something of a myth that is very, very prevalent today, specifically got to do with the SIP money which is flowing into the market. So we looked at some categories. For example, look at the large cap category. And we've written here, which is one of our favorite lines, that flows follow returns. They don't cause returns, right? So if you look at these charts very closely, you look at the black line, you will see that whenever equity returns have become sideways or negative, flows have actually come down. And whenever returns improve, flows pick up, right? So it is actually counterintuitive to what feels like. And some of the proof is in the pudding. Over the last 15, 16 months, markets have been extremely flat, although the flows looking at the previous returns have been exceedingly strong. In spite of that, markets have not gone anywhere. They've been sideways, right? So which means that a majority of the money that we've seen in the market has come in the last 2 to 2.5 years, right? Majority of the flows, and a large part of that time period has not delivered what people would have expected it to deliver. So which means that you need to remember that flows, they follow returns. They follow and go where returns are coming, because most investors, all of us, are sort of slave to what has done recently well. So for example, think about it. If you do, let's say, a mental activity today and take a piece of paper and think about what are the top 10 or 15 securities that I need to buy today. Your mind will throw names which are in fashion today. You will think about gold, silver, or an Nvidia or FANG stocks or some domestic companies which have done very well. But maybe the future outperformers are not even in the list today. We don't even know. Maybe it is some pizza company or some company that we don't even know about today. Maybe it's an NBFC company or some healthcare company that we don't even know the name about today. For example, imagine that in 2020, Nvidia's market cap was less than $100 billion. And in 5 years, it hit $5 trillion. I don't know any analyst in the world who would have projected that ever, right? And similarly is the case for, let's say, gold or silver, the way that they have moved. Not a lot of people would have expected them to move in that manner. Therefore, whenever these moves happen, after they happen, most of us think that this will continue. And that is where we make the mistakes. And therefore, flows or the investment money follows returns. They don't cause returns, which means that if you throw money at an asset, it will not artificially start moving up. It may happen for the short term, but the longer term return will not come. If you go back to the slide number 1, you can see that the whole world has invested in equity in the last 5 years. Still, gold has beaten most equity markets, even on a 5-year rolling basis. Just imagine that. Because gold rally just started about 1.5 years ago or so. But stocks have been rallying quite a while, and a lot of money has been poured into stocks. Even then, the returns came somewhere else, right? The next myth is that the best funds of today are the best funds of the future. And here I've made an analogy here, which is in the slide. And, some of us think that when we look at the past returns, mentally, we think it in terms of, I've given an analogy of a scooter mileage. So for example, if a bike or a scooter manufacturer says that this vehicle is going to give 70 kilometer per liter of mileage, we think that if it is not 70, maybe it is 50, right? And we think that if a fund has given, let's say, a 20% CAGR over the last 3 years or 5 years, then probably it will not give 20, it will give 18, which is very good for me, right? But the markets don't work like that, right? And we've done an analysis here. You can see that in majority of cases, a top quartile fund, what is a top quartile fund? Which is the top 25% of performers. In the next 3-year period, they don't continue to be the top performer. They slip into the second, third, or fourth quartile. Their performance goes down. And in many cases, the worst performing funds, they come up and they become best performing funds, which means that performance is also cyclical, and fund performance is not a popularity contest, which means that if you think that the most popular funds of today are going to be the best performers of the future, the data does not say that. It doesn't support that hypothesis. And therefore, in some cases, a better strategy should be to focus on where the investment philosophy is sound and consistent. And if that kind of strategy is underperforming, probably for some right reasons, then it will make a comeback. That is one frame of reference to think about. I think there are a lot of other frame of reference to think about, which we'll write that about in the future. But one very clear negation that you should do is do not mistake the popularity or the recent performance of funds for their future performance. They don't correlate with each other. Myth number 8 is the myth that we hear every starting of the year, where a lot of people ask, what is your target for 2026? And we did an exercise where looked at the price target for S&P 500 in US and Nifty in India. And you can see that there is a huge difference between the targets and what actually happened, right? In some cases, the performance differentials are 50%, which means that people were saying that, our analysts were saying that the index will go to 100, it went to 50, which was in 2008. In some cases, it rose much higher, for example, 20% higher in 2021, in case of S&P 500. The most interesting aspect about this analysis is that in no year or in no market did any analyst estimate tell you that index will fall. Just imagine that. So, for example, if you talk to an expert today and ask them what will be the Nifty or a stock target in 1 year from now, almost all analysts and experts will tell you that it is going to go up, right? If you ask earnings estimate from anybody, they will tell you that earnings are going to rise. They will go up. Now, what is most interesting aspect about this analysis is that human beings are inherently optimistic. Okay, or it could be that people don't want to hear that stocks will fall, or it is an inconvenient truth, and therefore projections are like that. But the reality is mixed. You can see that there are years when stocks don't do well. There are years when they do extremely well, and therefore there is no reason to follow any index targets because I think it's a coin toss. And therefore, we do not have any index target, neither do we have any projections. And therefore, we wrote this report about market myths. Myth number 9 is that over the long term, today's valuation won't matter. And this is a myth which is very important to make, because when stock becomes very expensive, they are unable to beat bonds over a sufficiently long period of time. You can see that we've taken some starting points which are extremely expensive, where stocks became very expensive. Eventually, for prolonged period, for 10, 15 years, in some cases even longer, they delivered returns similar to the Indian bond market. This is the Sensex, right? And what was the reason? Stocks became so expensive that eventually returns did not come if you're an investor. Now, one point is that there is no investor who will invest on that day and forget about it, right? Yeah, of course, people will continue to invest even in the down market, and eventually their returns will be much superior when stocks improve. But the moot point is that how many investors who start, let's say, in a year like 2000 or 2008 and continue to see no returns for 6 to 7 years, or muted returns for 6 to 7 years, can continue with a hefty exposure in equity, right? With a very large exposure in equity. I think very few, and only the experienced ones, right? So what is the right frame of reference to think about it? That when stocks are expensive, you need to mix other assets as well. That will give you more durability to buy stocks when they become cheap, right? And that is the time when they deliver outsized returns, and therefore valuations matter a lot. Starting valuations matter a lot, and you have to pay a lot of attention to what the starting valuation is at that point in time. There is a method to overcome it. We will discuss that in the last slide, which is the myth number 12. Right now, myth number 10 is about small and mid-cap stocks. And we've made this chart repeatedly for a few years. It shows you that in each cycle, when there is a bull market, mid and small cap stocks outperform large cap by a very wide margin. They rise in price much more than large caps. When the bear market comes, they lose all their outperformance. And it has happened repeatedly. Currently, we are in the 5th year or 6th year of mid and small cap building on their outperformance, although the extent has stopped. Over the last 15 months, their outperformance has sort of stagnated or started to come down. It's very clear that whenever the next bear market comes, we don't know when it will come, there is a high chance that they will once again lose their alpha against large caps. And we think that this is the right time to be in large caps, right? And so the myth where we are addressing here is that mid and small cap, if you buy them for a very long period of time, they will continue to deliver better returns than large cap. This may not be true. The outperformance and underperformance, both of mid and small cap, is cyclical. When they underperform significantly, that is the time where they deliver very high returns in the future. And we've highlighted this in the past. I remember in December 22, NETRA, if you go and read about it, we were at a position where, mid and small caps, I think this was precisely the position where mid and small caps were quite attractive. in terms of valuations, in terms of froth, where we highlighted this fact. And now I think for the last 15 months or so, we've been highlighting the opposite, where I think they become slightly problematic. And all these are cyclical. There will come a time when they will become much better. But at this point in time, caution is warranted. Myth number 11 is high risk means high returns. High risk usually in terms of, let's say, market volatility or measured by beta. And we've looked at here, low beta and high beta indices. You can expect the high beta index because it is highly risky to deliver more returns, but it has delivered much lesser return than low beta stocks. Same is the case with low volatility stocks delivering much higher returns than high volatility stocks. So this directly goes against the principle that if I increase my risk, I can increase my returns. The reason is that if you increase your risk by the way of volatility, the range of outcomes of your returns also increases, which means that you can actually make a lot of money or you can actually lose a lot of money. And eventually your returns will dependent on what is the end point. And which means that by increasing the portfolio volatility, you're also increasing your odds or rates of ruin. And that is what causes these strategies to, create highly negative outcomes. And therefore, you have to be very mindful of these narratives that by taking on more risk, whether it is in a particular asset or a type of asset, I can improve my return odds. In fact, sometimes the opposite is true, that by reducing risk, you are actually improving your odds of making higher returns. Now it's the time for the last myth, which is timing your SIPs matter, where I said that there is a method to make valuations irrelevant. That method is that if you start a SIP and you never stop it, eventually over a very long period of time, long period is what, 10 to 20 years, you would have purchased stocks at an average valuations. And if you purchase stocks at average prices and average valuation, whenever they go up, you make a lot of money. And that is what a systematic investment plan is. And therefore, stopping it or not doing it is not logical. We've shown 3 data points here that if you start a SIP when the index is at a lifetime high, the 7-year median returns for Nifty 500 is about 13%. If you start a SIP when the index has rallied 20% or more in last 1 year, returns are 14%. And when you start a SIP when the index has fallen by 20%, the returns are 12%. So about a 1% variation over a 7-year period, which is a large number, but not too large. 12 to 14% range itself is a very, very good outcome from an absolute perspective. What is the takeaway? Now, let me also clarify one very important point. If valuations are extremely high and stocks are extremely expensive, let's say today in the mid and small cap space, and you start a SIP and you see that in the next 1 year, your units lose 25 or 30% of their value. This is an assumption. Majority of investors will not be able to continue their SIP and they will remove their SIP thinking this does not work. And that is one of the reasons why, SIP start at a very high valuation or a very high price behaviorally is a challenge. But if you can overcome that challenge by creating an automated SIP where your emotions or your thinking does not matter, then it can be taken care of, right? So it has to be a black box, a decision that you do not ever stop. But if you do not take that decision or you try to intervene in the strategy in between, then probably the outcome will not be as favorable. And therefore, we've written here that the only rule of SIP to deliver what it promises is to start and not stop, because it eventually delivers average outcomes over a very long period of time. The last slide is mostly behavioral. It says that a little bit of noise is hormetic in nature. What is hormesis? That if you do a little bit of harm here and there, you get favorable outcomes. For example, exercising or fasting. These are hormesis. Small stresses, if you give it to your body, it becomes stronger. But if you increase the noise too much, it becomes toxic. And we've shown here that about 30, 40 years ago, people had access to stock prices a day later. Their decisions were smaller, lesser. The chances of them making mistakes were also lesser. And then there came an era where people went to the stockbroker's office to see quotes which were live in nature. So their noise dependent on access when they went and access. Today, that noise is live. You see all these news articles, ideas, views exchanged on a live basis, and the access to information itself can increase toxicity and push you to act. And the more you act, the more the chances of making a mistake. And therefore, choosing products or ideas where the number of decisions are lesser, where you do not have to execute again and again, increases your odds of getting extraordinary returns or at least decent returns over a very long period of time. So I will stop here. These are all the myths that we wanted to address.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.